Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, December 18, 2024. We are looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? We have what's called a big time reversal day on volume. Down here at the bottom of the screen, you can see the volume bars. You can see the tremendous breakdown candle from today. Let's use the market itself as a point of reference. When's the last time we saw a big time breakdown candle like that? Here's a big time breakdown reversal candle. Market went down, but there are none as we've seen today. As a point of reference, the SPY was down $18 today on close. The ES, the H contract, is down 216 points as I make this video, still clicking off before the 415 close. The reason why I want to point out this candle to you is because now we'll use another point of reference, and remember what we were talking about when I brought up the SMH and we had that heavy volume, big time reversal day. I said, watch this candle until or unless they recapture this candle. No dice on the upside. They did go down. They tried to recapture it. They went down again, and here they are. They never were able to recapture the high of that candle. That was what we call a sign and or signal of a trend change. This is obvious trend change, but it's also a big time change in character for the market. Now, what does all this mean? Let's go over to the weekly chart. We're not going to need this trend line anymore. As you can see, by the way, just to wrap up this trend line, look at that trend line we put on the board. We were watching it, and look how the market respected that trend line, and it rode the trend line and essentially rejected price at the last hit of the trend line. We're finished with the trend line. We have a weekly chart. What have we been saying? The weekly chart was getting too far from home base. I didn't think it would come back all in one fell swoop, but here we go. Today, we're coming back toward home base. The market is above all the moving averages. You're going to hear all kinds of hair pulling out kind of stuff in the media today. The Fed this, the Fed that, the Fed was hawkish, the Fed's going to do this, the Fed's not going to do that, they're not going to cut interest rates next year enough, all this stuff. The market is in tune with money flowing in, money flowing out. In my opinion, today was a fantastic excuse for the weekly chart to begin coming back toward what? Home base. Home base is what? The 20-period moving average. Still yet, and it's hard to believe after a day like today, but above all the moving averages, the trend is your friend. Here on the weekly chart, big picture stuff, we have a big time breakup candle low that represents a spike through the weekly chart 20-period moving average. It's really down about 470 and change. The exact number is at 467.89. That's the low. They don't have to get all the way down there. The 20-period moving average is right around 575. That's a big fat round number. I want to point something out. We're focused on the automagical calculator right now. This comes from one of the members that took the MSF masterclass. They have access to the calculator day in and day out. He puts a pivot high in, comes out with a couple of support levels, and he shows me a picture of what happened at the support level. And his comment is, "Hello, David, un-F-believable, how, question mark." Pretty interesting stuff. Automagical calculator, thanks Dima. Dima is a longtime member, a user of the magic calculator. So where do we go from here? What's that blue line at 582.58? That's a magic number. I would write that down, put it on a sticky note. Below that, you have a gap left open from the 5th of November. Remember that breakout on the 6th of November? Here is the gap higher open. They've basically taken back the entire thing since around the 3rd week of November. This entire rally was taken back in one afternoon. Today was what we call a meltdown situation on the Fed announcement, kabuki theater, hawkish stance, Jerome Powell presser, all that stuff. The market took it as an excuse and sent the tape unraveling. This is what we call a rug pull event. Anybody remember this thumbnail from last night's video? The last about 4 or 5 said something very similar to this. So we have a couple of important areas on the board. You have this low area right here. You have a number right below that. It's in no man's land. So if they get below this area here, and the low I think is this candle, 583.86, you have a number just below that, and then you have no man's land down to the gap. That official price is 576.70. Can you get a reflex snapback type rally first thing in the morning? A DCB? Absolutely, we could get a DCB. So here's the way this thing plays out. You're either going to get follow through right away, which is going to be another thrashing, or you start to get some kind of a bearish wedge, a bearish flag thing developing. So you'll get maybe a DCB, an up day there. You get another one, maybe it starts to form a flag pattern or some kind of a wedge pattern, and then you get another one like this. And then either they're going to start climbing the big time breakdown candle, or they're not going to be able to do it, and they'll start to put in a bearish type of flaggish pattern pointing to energy be released in the lower or southern direction. That's what we're going to be watching out for over the next few sessions. Little housekeeping, speaking of the next few sessions, we have a regular trading day tomorrow. Friday, inside the numbers and the live room, we'll be taking a day off. We will be closed. Next week is the week of Christmas. We will be open on Monday. We will be closed. The market will be open half a day on Tuesday. We will be closed. The market is closed on Christmas Day. That's closed. And then from there, we'll discuss it further. Back to the spiders for a moment. Remember, this whole area is still a former breakout area. Now, they've already run a test of it, and that's where they found support at the end of the day today. So they broke out of it here, went up, came back for a quick retest, and then had this long-standing rally over the last month or so, and now they've come back to test it again. Inside of that, and you're now playing around with the entrance to no man's land, and then you have the gap down below, and we have a number or two in between. Inside the number, members will have the numbers accordingly first thing in the morning. About inside the numbers, speaking of which, I know it doesn't seem like much after the fact, but the morning session was pretty decent trading, and believe it or not, we caught low of day in the morning session before the kabuki theater collapse. We were long gone by then. Nobody has a position unless they were gambling around the Fed, and I said it multiple times in the live room, everybody's going to be flat leading into the Fed. So we had a bounce opportunity this morning. We caught the morning low, and we had a nice trade, turned into somewhat of a Whopper Junior. Now, I want you to pay attention to something here. We've got an early pivot at 606.45. Let's just pay attention to that for a second. Now, here's a picture of the chart with the pivot on it, and you could see 606.45 was the pivot. Looks like high of day, right? Wrong. High of day was 606.41. They missed it by literally 4 pennies and essentially collapsed back down. Now, I'm not going to sit here and say the reason the market collapsed back down is because they missed the pivot by 4 cents. All I'm saying is they missed the pivot by 4 cents, and ultimately the market went way down later. The reasons don't really matter. It was the Fed. It was the excuse of the Fed. It was money flow. It was whatever you want it to be. They missed the pivot by 4 cents. So we can forget about the above on candle closes business, but let's look down south. The flip side situation is staying below the pivot, where price will have an open door policy to fall back toward 604.95 and a gap just below sitting at 604.25. All right, fair enough. Let's see what we have at 9:15, where we say, what's the scoop today? In other words, where's the trade? The thieves in the morning sold the tape leading into the opening bell. Great, maybe they'll create some volatility and opportunity. Absolutely. 603.70 to 602.75, give or take, is a support zone and a bounce back in the other direction place for a scalp with potential. It's as clear as day. There's a 5-minute chart of the SPY. Right of the vertical is today's activity. The blue line is 603.70. It's as clear as day, and you can see where they went to. They went back 4 cents short of the pivot. Traders in the live room, we took our base hit, and we did ride it. Many traders were able to ride it over 605. It was, as we say in the trading parlance, a nice trade. That's all we needed. We weren't going to trade in front of Kabuki Theater. Pause the video, read the notes, go back to the chart, and double check the work. 10:05, and there's your 604.95, give or take. Funny how that works. That was our target on the long trade from picking off the morning low. Funny how that works. Pause the video, read the notes, go back to the chart, and double check the work. What about Camp IWM? Pretty decent collapse today. IWM down over 4%, over $10. We don't need any lines anymore on the chart. What we need is where are they headed next. Let's clear up some of the noise. And as you can see, what they did today was run a test already in the neighborhood of the next breakup candle low in the sequence. They spiked through the weekly 20-period moving average like a hot knife through butter. There's an important number for you, 216.85. It's slightly below the breakup candle low. We don't know whether they will or won't crack that, but if they do, they're likely, at least in the same day or in the same week, they're likely to fight back toward the breakup candle low to recapture it once broken. Write that down. Put it on a sticky note. We don't look at monthly charts a lot, but this one's worth looking at as we come into the end of December. We will be watching for a reversal candle of the last up candle in the IWM. This had a tinge of market symmetry, the last candle from November. If they put in a reversal candle and reverse the entire candle from a monthly chart perspective, that will be somewhat, as they say in the trading parlance, ominous. What about the folks down at the transportation department? Down 454 points, almost 3%, headed toward the daily chart 200-period moving average, cut through the 100 like a hot knife through butter. This is my second favorite market leading indicator, but a number one canary in the coal mine. You could see cutting through the weekly chart 20-period moving average, last breakup candle low in the sequence, headed toward the 50-period moving average. I would write down 15,730 on a sticky note. It's an important number. It represents a weekly spike through the 50-period moving average and an area where they would most likely want to defend and bounce back the tape. 15,730. Defense likely run out on the field around that place. Write it down, sticky note material. What about the Q people? What does this blue line represent? It represents the most recent breakout area. The high here is 515.58. That's the blue line. They came into it today, and you see in small time frame, 5-minute chart, what happened. They certainly got a nice intraday rip off that, but did come down toward the closing bell, but still held from a support perspective. Good to know. Why does that happen? Because markets like to come back and retest the most recent breakout area. They're good, generally speaking, at minimum from an intraday perspective. How many times and where have you heard that before? How you doing? Big volume, big candle, no other candle like this on the screen. We're going to heed today's candle across the markets. It's a character change. What do we see when we flip over to the weekly chart of the Qs? We see a reversal candle in the making. They were extended from home base. We talk about it every single night. So it's no wonder, nobody should be surprised that they're coming back toward home base. And if they do continue lower, you can write down on your piece of paper, your sticky note on your screen, next to your desk, wherever you want. You can write down 503.50, give or take. This is a weekly chart. The weekly 20-period moving average is nowhere near price. They're coming back toward home base or the 20-period moving average. When markets get too far from home base, they do what? They either go sideways for a while, let home base creep up to price, or they come back toward home base. Where have you heard that before? How many times have you heard that before? About the XLF, 49.90 was the bogey. Once they gave that up, it turned bearish. Here they are. As you can see, a thrashing kind of day for the XLF, down 3%. Where did they come to today? The most recent breakout area when you consider where price is. There it is right there, and that's where they pretty much stopped on a dime today. We'll give that a funny how that works. The only other thing below this current area is a gap left open, closing print 46.71. That would be the next stop / objective on the downside. Spike it through, hit the 100 period moving average. If they did that anytime soon, there's likely garden variety of chart support in that area. Back to the SMH, or Smash Mouth, Philadelphia Semiconductor Index. Hit the top of the triangle, right down to the bottom of the triangle. Closing below the triangle will promote more downside activity. Let's see if this was a one-day wonder or something bigger is developing with the big-time character change of the market. Big-time triangle, when they're out of time, they're out of time. They do not have to get to the apex of the triangle. They can certainly break up or down before getting to the apex of the triangle, but once they do get to the apex of the triangle, it's generally all she wrote. They will break in one direction or the other. Write that down, put it on a sticky note. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.